Good afternoon, my Your Valued CPA listeners and viewers out there. I am so delighted to be here with you today, and I have a really special case study that I want to go through with you. And once again, whatever you hear in this podcast, make sure you always contact with your tax professional and tax advisor because what I'm about to share is not your specific tax advice. You're going to have to consult with your hired professionals to be able to determine what you can and cannot do. However, this case study I've been following this for quite a while. And what's very interesting here is this is the case study regarding Hunter Biden. And what I want to make sure we go through in here is avoiding IRS tax no pitfalls. And what's so incredible about this case is it's completely publicized. It perhaps blown completely out of proportion in its publicity because if this happened to an average business owner, it probably wouldn't have gotten this much hype. But all politics aside, it doesn't matter what side you fall on. Every single business owner can walk away with the tools from this case to help them avoid pitfalls that are actually fairly common. So, allow me to go through those with you. All right. So, at the end of the day, we want to make sure that we're analyzing what the IRS has provided for us in the IRS code in the best way possible. And sometimes, in order to do that, instead of relying on our own mistakes, we have to rely on other people's mistakes. And it's sad but true. And in this case, I want to use this Hunter Biden case study as something that everyone can walk away with in a positive manner so that you don't make the same mistakes. And at the end of the day, it's how do you crack the IRS code? How do you make decisions? How do you build the structure to support those decisions? And how do you create a system so you don't fall into the traps that many business owners fall into sometimes? Okay. So now that you're following me, and if you're interested, I'm sure you're going to stay through to the end because I'm going to share with you the top mistakes that he had made and the top mistakes that many business owners make and how we can make sure we avoid them. Okay. So on January 10th, 2025, there was a letter sent to the Attorney General from the U.S. Department of Justice that provided the details of Hunter Biden's case. And I'm going to go through some things, and this is where I don't want you to tune out because I want to share with you the verbiage and terminology, and I'm going to accentuate the words and terminology that had offended the IRS and tax courts significantly. And then I'm going to go through a summary of the charges. And then I'm going to go into what could have been done to prevent this. All right, follow me. So, just so you know, these sources are from the Department of Justice. Some of them are from Fox News and some of them are from CNN. So, I pulled information from all parties so that this analysis is not biased. Okay. So, a well educated lawyer and businessman, Mr. Biden consciously and willfully chose not to pay at least $1.4 million in taxes over a 4-year period of time. Consciously and willfully. I want you to remember that. This is super, super important. Next. Hunter Biden's September trial revolved around charges of 3 felony tax offenses and 6 misdemeanor tax offenses. I'll go through those later, but at the end of the day, he failed to pay $1.4 million in taxes. Next, he spent millions of dollars on an extravagant lifestyle rather than paying his tax bills, and that he willfully failed to pay his 2016, 2017, 2018, and 2019 taxes on time, despite having access to funds to pay some or all of these taxes. Okay. Next, previous drug abuse, and I'm inserting this in quotes, insert any extreme life situation in here. It doesn't have to be drug abuse. This extreme life emergency could not explain his failure to pay the taxes. Next, these are not inconsequential or technical tax code violations. Super important to note. Next, he filed his false 2018 return in which he deliberately underreported his income to lower his tax liability. Okay. Next, he chose to keep funding his extravagant lifestyle instead of paying his taxes. Next, he chose to lie to his accountants in claiming false business deductions when in fact he knew they were personal expenses. Next, he did this on his own, and his tax return preparers relied on him because, among other reasons, only he understood the true nature of his deductions and failed to give his tax preparers records that might have revealed that the deductions were bogus. Okay, that was a lot, and I'm going to dissect all of this. But the key words to take away here are consciously and willfully, extravagant lifestyle, inconsequential or technical tax code violations were out the window. These were egregious situations. He deliberately underreported income. He funded an extravagant lifestyle. He filed a false business tax return, lied to his accountants, and didn't give them enough records. That's a mouthful, and there's so much fodder to analyze here. I'm really excited to share these next pieces with you because I think these are going to help you as a general business owner. Okay, so the summary of charges. I'm not going to go into every single one of these because anyone could look these up, but essentially there were 3 felony offenses, and it was essentially tax evasion, filing a false tax return for his personal, and filing a false corporate tax return. And then there were 6 misdemeanor tax offenses, and all of them had everything to do with willfully failing to pay the IRS on time. Okay, so was any of this preventable? You bet your tushies it was. Yes, this was 100% preventable. So what we're about to discover is, how does this apply to the average business owner? What is the takeaway? How to engage your trusted advisor? And don't neglect to pay and or fine tune your responsibility with records, okay? So let's make sure we follow this. Mistake number 1, conscious and willful. He chose not to pay. All right, so what are some proactive action steps that we can do as business owners? Because at the end of the day, let's all be honest, no one wants to pay their taxes. It's not whether you want to or not. It's, okay, how do we provide the information to your tax preparer and accountant? How do we account for everything, see where you stand, and then are there things that you can do to mitigate your taxes, to reduce your tax liability so you're paying the least amount of taxes as possible, but you can't consciously and willfully just avoid paying. All right, so some steps here are: be transparent. This is not negotiable. Tell your accountant or tax preparer what's happening in your life. Practice full disclosure. Okay, let's give an example here. Let's say a business owner tells their accountant that they're going to a networking event. Typically, it will be a deduction for the business. However, the business owner clarifies that the majority of the trip was a personal expense. Okay, so now what? This comment allows the professional to help you determine if any of the expense might be deductible or if we have to disallow all of it. The more supporting documentation you have to be able to substantiate this business networking expense, the more information the professional will have to be able to determine in your favor that it is deductible. But if you don't have any business supporting documentation, it's going to be disallowed. So the things to provide in this case, for example, would be itineraries, receipts, notes about the business event or trip, and any other details. And then plan to arrange a payment and be mindful of what tax mitigation strategies you have available to you. So just because a certain expense isn't deductible to you, there still can be potentially other things you can do to mitigate your taxes. But the number one thing to make sure you don't do is don't consciously and willfully choose not to pay. That's a big no no. All right, mistake number two, failure to pay. Failure to pay on time despite available funds. Okay. So this was very interesting because this could potentially be subjective depending on what type of IRS auditor you get. But essentially, at the end of the day, if you have the money to pay the IRS, don't go buy yourself a boat. If you have the money to pay the IRS, don't go on an $80,000 trip to Europe with all your children and spend a month out of the country. If you have to pay the IRS, don't do things that are going to raise massive red flags. I think it's pretty obvious, but it's not always obvious. Okay. So if you know you may have some trouble paying the IRS, set up an automatic tax payment plan. Make quarterly estimated tax payments to make sure that you're always up to date. For example, our office, anytime we file a personal tax return for you or C corporations, we make sure that if you owe taxes at the end of the year, you have estimated tax payment vouchers that are automatically included with your tax return so that you can proactively make the estimated tax payments so that you don't come across a situation next year where you can't afford to pay. Little payments throughout the year will help you so that you don't have to stroke a huge check at the end of the year and be in a cash flow crunch situation. I can't emphasize that enough. Another really important thing is if you know you have to pay and you have some control of your W 2 wages, you can also increase your federal withholding. For example, if your own business employs you as the shareholder and the owner and the employee of your business, you can increase your federal withholdings so that you're paying more to the IRS with every single payroll, whether you get paid weekly or bi-weekly, semi-monthly or monthly, so that you already have that prepayment made. Okay. Now, don't interpret this as me saying don't tax plan because that's not what I'm saying. I'm just saying when you're planning to pay for the IRS, look at the obvious ways you can pay them. Work with a tax professional to review your tax liabilities quarterly, especially if your income fluctuates due to your business. Also, communicate with the IRS and be open about any hardship you may be facing. They want you to pay your taxes. So they want to help you, help them pay your taxes and create a positive environment so you can pay them and be successful, even if it takes years to do so. They will work on a payment plan with you. Okay, next. Mistake number three, extravagant lifestyle. All right. I'm going to go through some action steps and then I'm going to circle back around to some commentary here. Prioritize tax obligations over discretionary spending. Maintain a separate account for tax savings, allocating a percentage of all business income for taxes, and make this non-negotiable. Build a budget that distinguishes between your personal and business expenses, ensuring that your taxes are being put away in this account, in this other checking account, in this other savings account, in this other market account, under your mattress, wherever you need to be able to save that so that when time comes and let's say you don't have any additional tax mitigation strategies, at the end of the day, you can still write the IRS a check. And as a side note, don't write a book confessing your secrets about your extravagant lifestyle while you're not filing your taxes or you're underreporting or you're committing some other type of fraud and you're essentially letting the IRS know, hey, I have a huge life and I have an extravagant lifestyle and I refuse to pay you. Don't do that, okay? Don't create a YouTube channel and showcase your yacht that you just purchased when you owe the IRS a tax bill. Just prioritize your debts, okay? And that could be a completely separate conversation. Okay, mistake number 4, deliberately under-reporting income to lower tax liability. The comment here for me, from my perspective, and what I have seen with colleagues, with other professionals, with other business owners, if you underreport your income, that's a jailable offense. Just don't do it. The IRS knows what income you've received. They receive W-2s, they receive 1099s, they receive K-1s. They could trace a lot of it, if not all of it. Okay, so don't underreport your income. The expenses, you can, as long as your expenses have a business purpose and you can justify them in generating more revenue or operating your business, that's where you're going to have to create more substantiation for yourself so that those business expenses don't come into question. Okay? Take tax compliance seriously. Understand that intentional mistakes can lead to felony charges, especially when you're underreporting income. That's a jailable offense. In substantiating your business expenses, you can do so and just make sure you keep receipts so that in case you ever get questioned, you will be able to prove to the IRS what legitimate business purpose that specific expense was for. Okay? This kind of goes without saying, but invest in regular tax education for yourself, your team, or hire a professional that knows and stay informed of changes in the tax law. All right. I mean, it's kind of obvious, but not obvious to anyone. One of the things that I get asked is, well, you guys are really expensive. Well, I think we're less expensive than making mistakes and having the IRS on your tail and having interest and penalties assessed because you haven't filed your taxes appropriately. So, is it because you can't afford it or can you afford not to? So, that's kind of the question. Where are you going to focus your time and energy and monies? Okay. The list goes on and on. So, mistake number 5, lying to your accountants and claiming false business deductions where in fact they were personal expenses. This is a piece that really bugs me because at the end of the day, I don't want you to commingle your funds. I don't want to see any of your personal expenses on your business accounts. There are over 1,600 tax strategies that you can use for businesses. And there's so many ways you can mitigate your tax liability legally. Why would you bring your personal expenses into the mix? Your personal expenses, if you get audited, are going to get completely disallowed. And the audit's probably not going to go in your favor if you're commingling personal expenses. So be transparent with your accountants. Clearly separate business and personal expenses and provide all necessary documentation. Kind of obvious, but it's not obvious. One of the things that I see as a common concern, not a mistake, but a concern with business owners is that they feel like they haven't taken enough tax deductions or they feel like they don't have any tax deductions, so now they're using personal expenses. And that's the first thing I throw out the door and out the window when clients engage with us or when they talk to me, because there are so many things each business can do. So one of the principles that we talk about at the office is CORN, customary, ordinary, reasonable, and necessary. CORN. Every single business has the ability to deduct business expenses that are justified to be able to generate the income, produce the clients, produce the sales, and make sure the business is operating. So there's general business expenses, and then there's expenses within each specific business industry. And I use the example of an attorney has different abilities to deduct expenses than a dog groomer, right? A dog groomer is going to be able to deduct dog brushes and dog shampoo and cleaning supplies for pets, whereas the attorney cannot because that's not their industry, right? But the attorney can not separate, but can deduct other business expenses such as continuing professional education, legal, professional, business, etc., that maybe the dog groomer cannot. So there's general business expenses and then there's industry specific expenses. So there's so much room, so much wiggle room, so much opportunities for business owners, but you do have to educate yourselves on that or make sure you're working with a professional that knows what they're doing. Additionally, implement strict record keeping for your expenses. Have an accounting system, follow things in an Excel spreadsheet, make sure you have separate business accounts, including receipts, business purpose documentation, corporate minutes, travel logs, etc., etc., etc. The more you have to be able to substantiate what you're working on, the more the more the stronger your foundation is. And essentially, the stronger your foundation is, the less the IRS can poke holes in what you're doing. The other thing that I want to make sure you know here is that there's primary and secondary documentation. Primary documentation are all your actual receipts that provide all the details, versus your secondary documentation are your bank accounts and your credit card statements that do provide a lot of information. However, let's use Costco and Target as an example, and Walmart. The big box stores, you can walk into a Costco, Walmart, and Target, and you can buy baby diapers, you can buy home decorations, home goods, you can buy school supplies, you can buy food, you can buy furniture, you can also buy office supplies, right? So when you go into these larger stores that are not obvious, we want to make sure you have your primary documentation, meaning your receipts, because then you can prove that no, Mr. IRS man, I did not buy $500 worth of baby diapers. I bought $500 worth of pens and office supplies, right? So the burden of proof falls on the business owner. Okay, I'm going to go to the next one. Mistake number 6. And this one's a big one and it irks me so much. The tax preparers relied on him. Only he understood the true nature of the deductions. Okay. So while tax preparers and accountants, they're professionals hired to assist with your tax compliance. However, the ultimate legal responsibility for the accuracy of a tax return lies with the taxpayer. There's no such thing as I had no idea, my tax accountant did it, and now all of a sudden you're not guilty of anything. No. This distinction is critical because even if a taxpayer employs the best CPA and the best tax attorney, they cannot shield themselves from liability if they knowingly provided false or incomplete information. I want you to hear that again. The business owner cannot shield themselves from liability if they knowingly provided false or incomplete information. Okay? Want you to be aware of that. At the end of the day, the responsibility falls on you unless the CPA or tax attorney helped you knowingly commit fraud. Okay? Tax preparers rely on the documentation and explanations you provide as the business owner, right? You didn't hire a forensic investigator. So unless something appears blatantly fraudulent, the tax preparer typically assumes the taxpayer is providing truthful information. Okay, so we rely on you heavily. And being in the tax preparation industry for over 2 decades now, I only want to work with clients and business owners that are truthful and honest and accurate because I rely on you. And I don't want the IRS knocking on your door, nor my door, to ask questions about your tax return. Okay, so we rely on you to be able to provide all that information. Okay. And mistake number 7 He did not give records that might have revealed bogus deductions. This is really, really, really tricky. And it kind of goes back to the previous mistake number 6, where the tax preparers relied on him. So essentially here, if he gave records for his bogus deductions, the tax preparers would have poked around and asked the why questions. Does this make sense? Why did you spend X, Y, and Z? This looks like a personal expense, or this doesn't support any of your business structures. Okay. So if we have the documentation, we can poke around and ask the questions. But if we don't have the documentation and what you're providing us looks reasonable, well, we don't have any reason to ask you for it. So we trust what you're doing. Okay, so what are some steps that you can do? One, provide your tax preparer with complete and accurate documentation for all your income and deductions, especially deductions that are atypical, meaning red flag items that may require specific treatment and larger purchases. For example, purchasing equipment, purchasing automobiles, purchasing real estate, purchasing airplanes, purchasing boats. Some of these may be completely disallowed. Some of them might be partially allowed, and some of them may have special reporting requirements depending on how your businesses are structured, how your businesses are operating, and what specific tax consequences and tax elections your business has made. So, if the same person purchases the same vehicle, for example, yet each person has a different business entity type, it's possible that every single one of those entity types may treat that purchase differently. So don't assume anything. Give your tax preparer all their records. Okay. And next, it's the taxpayer's responsibility as the manager and the owner of the business to decide what's for business purposes. And you have to document your business decision in your corporate minute books, in your ledgers, and in your receipts. Okay. We're not deciding, your tax preparers and your accountants, we are not in a position to decide whether you should take that as a business expense or not. You are the manager and the owner and the employee of your own business. If it has a business purpose for you, then you need to document it. Okay. Now, do you have the risk of the IRS potentially disallowing it? Of course, you do. The stronger your records are, as long as that business expense follows corn, customary, ordinary, reasonable, and necessary, as long as that business expense falls within your industry, as long as that business expense is not an atypical outlier that typically wouldn't be used in your business, and as long as you have amazing documentation for its business purpose, the likelihood that it will be questioned decreases and decreases and decreases. So that's what I want you to focus on. So, what's the problem, right? We know that taxes are the third largest household expense. We know that 93% of business owners overpay their taxes. We know that 8 out of 10 entrepreneurs who start their businesses fail within the first 18 months. We know this, but we cannot cut corners. And this is exactly what this case shows us. We cannot cut corners. There are legitimate legal ways to be able to minimize your taxes legally. That's documentable, if that's a word or a phrase, that you can document, you can substantiate, and you can feel good about filing your tax return. And that's what I want to leave you with. That, in my world, is tax strategy. And tax strategy is typically something that people think maybe that might be too expensive for them, that maybe, they're not ready for it. But every single business owner has the ability to strategize. And at the end of the day, you have the control in your hands as long as you're talking with a competent tax professional that can help you navigate this whole IRS code, your business deductions, and really get you to the next level, right? So there are ways you can pay less taxes, increase cash flow, and keep more money in your pocket. I don't want you to make the same mistakes that Hunter Biden did. And I really, really hope that this case study helped you see that any one of us can trip up and make a mistake and an error. And at the end of the day, we have to make sure we reconcile it and know the code, speak with the right professional so we're not doing something silly. All right. Have an awesome day. And I certainly hope this helped. And I look forward to hearing your feedback. Bye.